Good morning. Why low rates have created hidden risk. And for years, historically low mortgage rate felt like free money. And borrowers locked in 2 to 3% interest rate. And investors leveraged aggressively, and home prices surged, and equity exploded. But here's the uncomfortable truth: low rates don't eliminate risk, they just shift it. And as a mortgage broker and capital markets advisor at Medallion Funds, I saw firsthand how ultra low interest rates changed borrowers' behavior, and not always for the better. So let's break down the hidden risks that low rates have created and what smart borrowers should do differently moving forward. Number one is payment shock risk. And when rates stay artificially low for years, people assume that that environment is permanent and it should continue. It isn't, it wasn't, and it isn't now. And adjustable rate mortgages or ARMs or short term commercial debt or bridge loans and construction loans were underwritten assuming that refinance would be an easy task. And when rates jumped, so did monthly payments, those spiked. Debt service coverage ratios compressed, and refinances became harder, and equity cushions shrank. And what low rates did is they masked future payment risk. Two is over leverage and thin margins. And cheap debt encourages folks to leverage to the hilt. And investors purchased loan to value ratios that may have been a little higher than normal. And home buyers stretched their debt to income ratios to get into homes. And developers used floating rate capital, assuming that cheap extensions would be easily impossible. But that low cost of capital reduced discipline. And when rates rose, cash flow tightened and cap rates expanded and valuations corrected downwards and exit strategies disappeared. And the risk wasn't the rate, the risk was the structure. Asset price inflation is our next category. And low interest rates don't just lower payments, they tend to inflate asset prices. And when borrowing is cheap, buyers tend to bid more aggressively. And then sellers raise their expectations for what the pricing of the market is. And investors accept lower cap rates on deals. And what this does is it creates a valuation distortion. And when rates normalize, buyers demand yield, and cap rates expand, and values adjust. And the borrower who focuses only on the rate and not the structure, their liquidity, or their long term sustainability, they become vulnerable. Four is it gives a false sense of security. Low rate environments create psychological complacency. And people tend to believe that refinancing will always be available and appreciation will always continue, and that banks will always compete aggressively for their business. And the point is, capital markets move in cycles, and structure beats rate every time. Five is the refinance illusion. And during the low rate era, refinance became a strategy, and not a backup plan, but a simple strategy. The point is, refinance depends on a few variables, and one of those is the appraisal value. Two is your debt service coverage and income stability, but also your liquidity for lending purposes. And when any of those tighten, refinance options can disappear. And borrowers who relied on it learned a hard lesson. So let's talk about what smart borrowers do differently now. Well, in Medallion Funds, we focus on stress testing your cash flow and modeling higher rate scenarios, but also structuring conservative leverage and planning your exits from day one, which in turn protects your liquidity. And the goal isn't the lowest rate as the primary objective. It is definitely a lowest rate objective, but the goal is more permanent, resilient structure first. And the mortgage lesson for 2026 and beyond is that low rates were never free money. They were simply a temporary market condition. And borrowers who built discipline, liquidity, and conservative structure survived the rate reset. And borrowers who chased yield without risk management struggled after the fact. So if you're buying, refinancing, investing, or structuring debt in today's environment, the conversation has changed. And today, it's no longer what's the lowest rate today, but it's become how do we build durability in today's environment? And that right there is the difference between surviving the cycle and leading through it. My name is Bill Rapp. I work for a company called Medallion Funds, where we do mortgage and capital markets advisory. You can visit my website at billrapponline.com to figure out how to get a hold of me. Love to talk to you further about your situation. Take care.